Hello and welcome to my channel. In order to make a sound investment decision, it is important to understand the financial health of the business. Understanding the economic health of the business also helps the investor in estimating the fair value of that business. So, in today's video, we will be focusing on reading the three financial statements of Apple. We will analyze income statement, balance sheet, and cash flow statement and understand the current economic health of the company. Finally, we will look into the key financial ratios and draw some important insights. So let us first look at the income statement of Apple. The first thing we look at is its revenue. The revenue of Apple is at $274 billion in 2020 and it grew from $65 billion in 2010. The long-term annual growth rate of Apple's revenue has been pretty good at approximately 15%. However, in the last 5 years, from 2015 to 2020, the revenue growth of Apple has slowed down to about 5% annually, which is something to look out for. Now, we look at the operating income. The operating income of Apple in 2020 is about $66 billion, which is approximately 25% of the revenue. Operating income grew from $18 billion in 2010 to about $66 billion in 2020, which is roughly 14% annual growth rate and is in line with the revenue growth rate. However, one important thing to note is that the operating income has dropped from $71 billion in 2015 to $66 billion in 2020. The drop in operating income can be attributed to the increased spending in research and development activities. From 2015 to 2020, the R&D spend has increased by more than 15% annually. Now, let's look at the net income. The net income for Apple in 2020 is about $57 billion, which is approximately 20% of the revenue. Although the net income grew from $14 billion in 2010 to $57 billion in 2020 at about 14% annually, it is important to note that the net income has remained flat for the last 5 years from 2015. The flattening of the net income can be a result of both slower growth in revenue and increased spending on R&D. So overall, the income statement for Apple looks pretty strong. However, it is important to watch out for the top line growth and results of the increased spending on R&D. Now let us understand the balance sheet of Apple. Apple has about $323 billion worth of assets as of 2020 and it grew from $75 billion in 2010. The total assets of Apple grew at roughly 15% annually. And out of $323 billion, roughly 80% is liability at about $258 billion and remaining 20% is shareholders' equity. One of the most important things to look out for in the balance sheet is the current ratio. That is, how much current assets does the company have in comparison to current liabilities. Current assets and current liabilities are assets or debt obligation that the company has to meet within the next 1 year. This helps the investor in understanding if the company will be able to finance its immediate debt obligation using the liquid assets it possesses. So for Apple in the year 2020, the total current asset is about $143 billion and the total current liabilities is about $105 billion, which means the current assets exceed the current liabilities. Thus, the company would be able to finance its immediate debt obligations. Historically, for all the years, Apple's current ratio has exceeded 1, which is a signal of a strong balance sheet. Thereafter, we look at the cash on hand. As of 2020, Apple has about $90 billion of cash. Compared to 2010, when Apple had about $25 billion worth of cash, it has multiplied by almost 4 times in the last 10 years. However, the cash in hand has dropped from 2019. This is primarily driven due to share buybacks. The company utilizes the available cash to buy back its share and return some of the value to its shareholders. We will further look at some of the key ratios from balance sheet in the final section and draw some more insights. The third and most important financial statement to understand is cash flow statement. It is not only important to look at the profitability of the company, but it is equally important to look at the in and out movement of cash in the business. The cash flow statement is important because, for example, there are certain businesses that are profitable but operate on offering credit to the customer. Such businesses might not generate cash immediately as the customer is acquired on credit. So they might have to borrow money at higher cost to meet working capital requirements. Thus, it increases the cost of doing business. The cash flow statement exposes some of the critical risks in the business. The first thing we look at is the cash flow from operating activities. In 2020, Apple generated about $80 billion in cash, and it has exceeded the net income for the year. For each of the last 10 years, the amount of cash generated from operating activities has always exceeded its net income, which is a very strong signal of a robust cash position that Apple has. The cash from investing activities has been negative for most of the years for Apple, as it has been investing in expansion and acquisition activities. We also see a negative cash flow due to financing activities. This is primarily because Apple has been utilizing the surplus cash to return some of the shareholder value through share repurchases and paying dividends. Thus, looking at the overall cash position, Apple has a pretty strong cash flow management. Now we will look at some key financial ratios and draw some insights about the economic health of the business. The first and most important criteria to assess a business is return on invested capital. For Apple in the year 2020, the return on invested capital is about 35%. Usually, a return on investment greater than 15% would be considered very good, but Apple has significantly outperformed, and its performance is not only good for the year 2020, but it has consistently maintained a high return on investment for each of the last 10 years. This shows that Apple has a huge competitive advantage, which gives it a significantly high pricing power. Thereafter, we can see that the operating margin is about 24% for the year 2020. Although it is a good operating profit margin, but compared to its recent history, it has dropped from about 30% in 2015. As discussed in our income statement analysis, this drop can be attributed to increased spending in R&D. We see a similar trend in net profit margin. The net profit margin for 2020 is about 20%, which is a very good margin, and Apple has been able to consistently maintain a very high profit margin for all of the last 10 years. This clearly highlights the pricing power that Apple products command in the market. Moving on to liquidity ratios, we observed that the current ratio has consistently stayed above 1 for all of the last 10 years. Thus, Apple can meet all of its immediate debt obligations. Thereafter, we observe that the debt to equity ratio for Apple has increased in the recent years from below 1 in 2015 to 1.7 in 2020. However, this won't be concerning in case of Apple because of a very strong cash position that Apple has, and it seems more like a management decision rather than a necessity to keep higher debt levels. Cost of debt financing is lower than cost of equity financing. Hence, the management often decides to return back equity to shareholders while increasing the financing through debt. Overall, the financial health of Apple is very strong because of consistent high return on investment, strong profit margins, good liquidity ratios, and strong cash flow position. However, the only thing to watch out for is the future growth in revenue of the business, and how does competition affect Apple's business and its competitive advantage. I hope this video helped you in understanding the financial health of Apple. Thank you.